Global financial markets have had a more volatile ride in 2018. There's been a fair bit of turmoil in emerging markets, which has hit South African assets quite hard. US markets have remained the beacon of strength within global financial markets, but the South African market has been negative year to date. So in line with other emerging markets, the South African assets have performed poorly in 2018. The rand has depreciated, bonds after initial rally in the first quarter have sold off heavily, as have domestic equities. We are taking care to avoid the crowded parts of global markets. We think popular stocks are largely very expensive, but we think one of the anomalies of current market conditions is that there are significant opportunities in parts of the market that are out of favor. And here in particular, I reference South African domestic stocks, where companies are very cheap on low levels of earnings, particularly mid-cap South African industrials, where we're finding great opportunities. And also on a stock-specific basis, there are good opportunities to mine uncrowded areas offshore. And similarly, we're finding great opportunities to buy great businesses at very low valuations. The PSG Flexible Fund remains relatively conservatively positioned. We have cash levels of 18%. Which we will deploy when opportunities are more broad-based. The reason our cash levels aren't higher is because we're still finding good opportunities within equity markets. We've been buying some South African industrials at low levels of earnings on low PE ratios. We've also been carefully selecting within global markets, and we have some high conviction ideas that have been appearing in our portfolios. If I look at the price-earnings ratio of the PSG Flexible Fund, it's 12.8 times, which is a significant discount to the broader market as represented by the JSE All Share of 17.2 times. It speaks to the fact that we're finding cheap stocks, higher quality businesses within parts of the market that are deeply out of favor, which should be good for long-term returns. We also have a significant offshore exposure. We are directly invested to the extent of 27% of the fund in offshore equities. We also bought South African bonds in the first half of 2018, and we have a 6% exposure to the R2037. We see a significant opportunity to lock in real yields for our clients, particularly at the long end of the South African bond curve.